we have in our conference room a number of slogans that are on the crown molding around the room. And the first one you see says the bottom line of all investing is rate of return. And we believe that's in our DNA. And so everything we do about selecting an investment goes to the issue about how can we best understand what the rate of return opportunity is in that investment. We believe that whatever return the business has itself will be reflected in the share price over a period of time. We do some simple little arithmetic to reinforce that. Then when we find a business, we really focus on three issues, and in the shorthand, we've all talked about that, called the three-legged stool. Mm-hmm. And so the first leg is understanding exactly what the nature of the business is and what kind of returns on the owner's capital does it produce. And then we want to see if it has the ability to do that for a long time, if the runway is wide and long, we say. So what's causing that above average rate of return to exist? What's going on? What's unusual about that business? So the second leg that we look at is the people who run the business. And we're very focused on the skill level of the people who run the business and look at their record and whatnot. But we also want to know that they're acting in the best interest of all shareholders. That is, we see that what happens in the business happens to us on a per share basis. Mm-hmm. And then the last leg of it is the issue of reinvestment. So we examine how it is they have reinvested free cash flow in the past, what the outcomes have been, and they rarely break those out, by the way. We have to do our own work. And then what the opportunity for reinvestment going forward is, because the fact that they can reinvest all of their free cash flow to earn above average returns enhances our compounding effect. And that's what we're after at the end of the day. We want to compound our shareholders, our clients' capital at an above average rate while assuming a below average level of risk. And the below average level of risk piece for us has got nothing to do with volatility. It has to do with the fact that the businesses we own on average have more returns on capital, have higher growth rates, have stronger balance sheets, and very frequently have lower valuations than the market at the time we purchase them. So on their face, they have less risk than the market, than average. So.